The COVID-19 virus has been one thing on everyone's mouth since the start of 2020, as what seemed like an isolated incident quickly spread into a global disaster. Currently, as to date, there are well over 2 million cases worldwide. And right now, it's hard to turn on any form of news headlines across the world without being bombarded by the grim news of how the virus is rising at an exponential rate, the overwhelming death tolls, and of course, how this has taken an impact on the way we may be living our lives for the next foreseeable couple of months or so. Now, outside the direct impact of the COVID-19 toll to physical human health, one of the most talked about issues is how the virus has set the world financial in shambles and pretty much completely stopped the economic wheel, down to the point of recession and possibly beyond. My name is Paul from Aroau Capital Holding, and today we'll give you a quick update on how we see the current situation of the COVID-19 crisis and its impact on the economy. Now, the dramatic spread of the COVID-19 and its direct implication to the human well-being probably don't need much further explanations. We've all seen how contagious this virus is. Everything in recent times pretty much is in shadows of this pandemic virus, and often people have been comparing this to the likeness of the Spanish flu in the early 90s. Though something of equal severity the pandemic has impacted on is the state of the global economy. This is because even if a vaccine would have been developed and the number of infected dwindled down to the current state of the economy this crisis impacted may linger on for much longer. Now, with all the governing bodies around the world having to adapt rapidly in order to contain the virus, there have been many difficult and harsh, but yet necessary decisions having to be made. The most important and I guess prompt being the social distancing rule almost every affected world has now implemented, and the compulsion limitation on how its business needed to be either closed down completely and others limited to the way it can operate in order to accommodate to the social distancing rule. Now, meanwhile, even though Australia has seen good numbers in flattening the curve, the unemployment rate has not shown collateral. And according to our Treasurer Josh Frydenberg, the current unemployment rate is at 10%, which he said would have been over 15% if it wasn't for the JobKeeper allowance that was recently introduced. This far outweighs both the 2009 GFC and the 1982 recession. This in turn, no doubt, would leave Australia's economy in a negative and revising down the initial forecast from a 3% increase to a contraction of 3%. Now, if you put it in retrospective, the GFC back in 2008, our GDP had only slipped over 0.1%. So this is much significantly higher. Now, this year, there will be no official forecast until the 6th of October, the date of the postponed budget. Though given the rapid changes with the COVID-19 virus, the economic figure outcome would really depend on a lot of factors, such as the scale of the infected numbers, how quick the vaccine can be produced, and the decision of individual governing bodies facing this crisis. Now, there are no doubts that with the massive spending on healthcare facilities, regulatory restructuring, tax reliefs, and stimulus packages, that it might take Australia decades before we are able to rebound to this pre-crisis position. Now, however, not all news are grim, as according to PwC, the first wave and often the biggest shock and uncertainty has already hit during the early March, where the virus first went global. We saw a massive 35% shrinkage across the global economy from late February and throughout March. And this is obviously due to the unforeseeable contagious level of the virus and its impact, which had caused massive panic and uncertainty throughout. So what are the predictions and where to from now on? Even though Financial Minister Althea Coleman says it is impossible to give an accurate forecast in the current situation, we can assess from the market movement that the people have started to absorb the impact of the virus and starting now to make rational decisions based on daily updates of information given. We know for a fact that the government is trying everything to keep the economy from collapsing. The impact of the COVID-19 crisis is no doubt being catastrophic, though in the glimpse of the unfortunate time, there remains much optimism. We can see this in some of the earliest victim countries such as China and Korea. After slowly flattening the curve of new cases, operations are now resuming along with business normalizing. Even Wuhan, the epicenter of the crisis, starting to slowly opening up its locked doors in recent days. And Australia may be one of the fortunate ones that can follow these footsteps, looking at our current statistics. Now, many financial institutions foresee a recovery starting the second quarter of the year. The IMF predicts that Australia's GDP will expand by 8.4% in 2021 after falls of 7.2% in 2020. They believe we are in the worst stage right now, and the recovery will begin in the September quarter that starts in July. Now, of course, this prediction is changing daily based on the trajectory of the virus and when a vaccine can be massively produced, which at this stage is the only complete answer to the crisis. Now, when it comes to investment, I think that it is important to stay vigilant and focus on long-term investments. The positive ideal is that in time of a crisis like these, often the market proves to also create a lot of opportunities. Warren Buffett was interviewed in recent days about his thoughts on what investors should do in response to the global coronavirus outbreak. And his take was that it wasn't a good idea to buy or sell stock simply based on daily headlines and global fear. If we trace all the way back to 1987, Buffett wrote to Berkshire Hathaway shareholders about what to do in the face of an epidemic. And Buffett stated that his goal to deal with these epidemic was to be fearful when others are greedy and to be greedy only when others are fearful. Now, there's no question that plenty of investors in fearful state right now. The so-called fear index or volatility index, VIX, has skyrocketed over the past couple of weeks. Now, when the VIX goes up a lot, it's a clear sign that many investors are scared. When Buffett wrote about being greedy when others are fearful, he was actually referring to buying stocks at an optimistic time. And the reality is that the market correction has left quite a few stocks valued at very, very attractive rates. Now, how we position ourselves will really depend on each individual and our own thematic approach to investments. With this potential opportunity rising from the current situation, we do need to keep in mind on how we're able to adapt to these changes that happen in times like this. Of course, this flows on to how we value companies, their operations, and their strategic goals in growth. And according to Goldman Sachs Chairman and CEO David Solomon on a recent podcast, we do need to be realistic at such time that growth by companies need to not only be responsible to shareholders, but also to the general public. The recovery period after the pandemic should be about ethical growth rather than pure profitability. And I think with those in mind, the companies that can correctly place itself in this fine line and adjust to this ideology that would likely be the ones to thrive and excel post this crisis and possibly become the new cash cows in the next forthcoming decades. Hope you've enjoyed this briefing intro, and we'll see you soon again.